Hello, you're welcome. We want to look at why audits fail. Of course, if you go online, you will see so many cases of auditors' liability, auditors getting sued, auditors getting fined and penalized, and even in certain extreme cases, license of an audit firm being withdrawn. Why is it that audits fail? One concept that is very central to the challenge of audit failure is audit risk, which every auditor must be aware of. So audit risk is the risk that the auditors will arrive at an invalid conclusion at the end of the audit. Audit risk has three elements. You have inherent risk, control risk, detection risk. Inherent risk is the risk that is more or less come naturally with the system, with the business, with the assets. Okay, for example, in banking, there will always be a risk that people will commit fraud because money is always available either in the physical form or electronic form. So there is an inherent risk of fraud in the banking environment. In construction, there is an inherent risk of accident because you have a lot of machineries, stones flying up and down, noise. So there is a risk of accidents in the construction industry. Oil and gas industry, you want to go to the rig, there's a risk of explosion, there's a risk of the barge capsizing in offshore. So those risks, they come naturally with those businesses. So a good auditor must know the inner risks that are specific to the area being audited. This is very, very, very important. Then, having understood the inner risk, then we look at the control risk. So the control risk is the risk that controls put in place by management will fail. So these controls, for one reason or the other, they might not be adequate, they might not be tested, and in the day of recording, they might not be able to save the organization from a breach. The CCTV may not record, all right? So that means the controls, it's not, the controls are not working as expected, okay? There may be a bug in an audit software that made it to fail in capturing exceptions. Okay, you have a security guard, the security guard maybe has gone to eat, and during that time, something uh, unwanted happened. So control risk is the risk that controls put in place by management will fail. Then detection risk. Detection risk is the risk that the auditors' actions or inactions will lead to a wrong conclusion being made. For example, you pick a wrong sample size, okay, or you interviewed the wrong people, or you interpreted the result of an audit software wrongly, or the auditor is inexperienced, or it's a first year audit. First year audit is always very challenging because you're not familiar with the environment yet. So that is detection risk. When you have a combination of inherent control and detection risk, it all boomerangs into the audit risk. So at the end of the day, there may be a problem which the auditor might not see, and the auditor will arrive at a wrong conclusion. So every auditor should be conscious of these three levels of risk. So you need to understand the inner risk in the area you want to audit. You need to understand the control environment. So you need to understand and appreciate the controls they have and test it. All right, test those controls to determine whether they are adequate, whether they are sufficient or not. The detection risk, as an auditor, you must be ready. You need to get the experience, you need to get the qualifications, then you need to familiarize yourself a lot with the area being audited. Then we look at threats to independence. Okay, a lot of time the audit will fail when the auditor has lost his or her independence. So we have self-interest. So this is where the interest of the auditor has merged with the interest of the auditee, such that the auditor will not be able to make an independent opinion. For example, uh, you have a financial interest in the auditee. Maybe you have shares, right? Or you and the auditee you are operating a joint venture together. Okay, so this can create self-interest such that if you give a negative opinion, it will also harm your interest as the auditor. So that is what we mean by self-interest threat. Then you have self-review threat. So self-review threat is a threat whereby the auditor is reviewing his or her own work. So you are the one that prepared the financial statement, and now you are the one auditing the financial statement. That is self-review threat. Then we have intimidation threat. Intimidation threat occurs when the directors decide to give the auditor a tough time. Maybe they are not cooperating, they are not giving you access to information, they are threatening to sack you, and sometimes in audit that might even be threat to life and well-being. So that is intimidation threat. We have familiarity threat. Familiarity threat is the threat in which the auditors are too close to the auditee in terms of familiarity, friendship, or even marriage. So you have a director in the auditee company being the spouse of one of the partners of the audit firm. So there's going to be a lot of challenge. Or the engagement partners has spent too much time on the audit. Maybe for the past 10 years, he has been the engagement partner in charge of a XYZ company. So familiarity will definitely set in, and this can affect auditor's judgment. Then you have advocacy threat. Advocacy threat is a scenario in which the auditor is now, like a lawyer, like an advocate for the auditee. So, for example, there is a court case, and they are not calling the auditor to come and testify on behalf of the client. So that can make you to start taking a position that may endanger independence, or they have a challenge with the authorities, and now you as their accountant or the auditor, they're not the one they are calling to come and defend them before regulatory authority. So these 5 components of threats can actually, trigger audit failure if the auditors do not have antidotes for them. Now, we look at ISQC1, quality control at firms level. Okay, that is the standard on quality control for auditors auditing firms. So, for example, ISQC1 says you should have leadership. That the leaders of the audit firm should provide examples. They should be the one responsible and accountable for quality within the organization. Total quality management, not only applying to manufacturing, but even also to audit process quality. The relevant ethical requirements, we have the IESBA Code of Ethics. In Nigeria, we have the ICANN Code of Ethics. So you need to be able to be ethical as an auditor. So you need to follow the Code of Ethics always. Then acceptance and continuance of client relationships and specific engagement. Of course, there are rules before you can accept a client. You need to do background check. Who are the directors of the company? Who are the managers? What's the business all about? Are they into money laundering? Are they ethical? All these background checks are very, very important so that you don't get it to wrong hand. You don't get into an audit and discover that you are auditing a mafia organization or a small screen for money laundering. Then you're in trouble as an auditor. So do background checks, all right, before you take up a particular audit engagement. Then of course you need to be able to check for what we call what we call precedence before you can take an audit engagement, preconditions that you must look at before you take up an audit engagement. So you need to ensure that the directors are taking ownership of the financial statement. That yes, you are the one that created the financial statement. Right? They must also be ready to give you all the information you need as an auditor. So that precondition must be there before you accept an engagement. And of course, it's not just at the first time, even for recurring audit engagement, you need to continue to check whether those preconditions to audit are still there. Then, of course, human resources. Do you have the people? Do you have, are they trained? Are they qualified? Are they certified? Are they motivated? So, human resources is a key component of quality control. The engagement performance, of course. So, you don't just send people to the field without a proper supervision, without proper training, without proper guidance. So there must be work ethics, there must be work plan, there must be audit working papers. Okay, there must be use of CATs, computer assisted audit tools. So we need to have a defined system for the audit firm in executing engagement. Then, of course, monitoring is very important. There must be the audit firm must have a system of monitoring activities from engagement planning even to the audit report uh, publication. So they need to be able to have monitoring system to be able to know what people are doing. All right, the feedback from the client, uh, employees, even feedback from your own people as auditors. So if anything is going on in the course of the audit, you'll be able to address it before they get out of hand. So this ISPC one is a standard that every auditor should go through. All right. Whether you're a financial auditor, you're a system auditor, you're an environmental auditor, you need to download that ISPC one and see what that standard has said. It's one way to be able to save yourself from all manner of heartache that can result when audits fail. So in this video, I have looked at several reasons why audits might fail. I've looked at audit risk. I've looked at threats to independence. And I've also looked at ISPC1 as a solution for audit firms, especially to consider when they want to safeguard themselves from audit failure. Thank you. My name is Akinwale Akindiya. Please subscribe to my channel so that you can have access to more videos from me.